Most people think being broke simply means having no money. Here's what most people don't realize. The cost of being broke isn't just obvious bills. It's hidden, systemic, and grows quietly over time. Consider someone living paycheck to paycheck, choosing convenience over planning. At first, this doesn't seem significant. A $5 late fee here, a slightly higher interest rate there, small numbers that accumulate silently. The hidden reality is that short-term financial choices compound. Paying more for convenience often replaces long-term wealth-building opportunities. Over time, these invisible costs dwarf the original expense, shaping financial outcomes in ways few notice. Financial systems are designed with thresholds. Credit, insurance, and banking privileges improve dramatically once a person crosses modest wealth levels. Below those thresholds, fees, penalties, and higher interest rates become almost unavoidable. Mathematically, even a few percentage points in extra fees or interest can snowball. $100 mismanaged today may cost $500 or more over 5 years when combined with repeated small penalties and lost opportunities. Psychologically, humans focus on immediate comfort. Paying extra now avoids friction, stress, or inconvenience, but this creates long-term financial drag. Emotional comfort often conflicts with rational, delayed wealth accumulation. Over 1 or 2 years, these small choices start to manifest as patterns. The person who pays for convenience consistently loses the ability to invest or save meaningfully, reinforcing a cycle of scarcity. Historical financial data confirms this pattern. During inflationary periods, individuals with fewer reserves experience exponentially higher relative costs. The system quietly magnifies disadvantage for those who cannot access better rates or payment structures. Here's a subtle truth. Financial visibility is deceptive. Someone may appear to manage day-to-day well, but the systemic cost of being under-resourced grows invisibly, measured not by immediate discomfort, but by lost long-term potential. Contrast short-term and long-term thinking. Spending $10 on a late fee might feel trivial today, yet over 10 years, repeated micro-penalties erode purchasing power far beyond the initial $10, demonstrating compounding costs of neglect. Behavioral economics shows that scarcity changes decision-making. When resources are tight, people default to simpler, convenient solutions, even if they are more expensive. This creates a self-reinforcing cycle where poverty triggers behavior that deepens financial strain. Opportunity cost is often overlooked. Money spent inefficiently today cannot be invested tomorrow. Even modest returns over time can outweigh initial convenience costs, revealing the hidden expense of short-term choices. Think of fees as tiny leaks in a bucket. Individually, each leak seems minor. Collectively, over months and years, these leaks drain resources that could have supported growth, security, or investment. Modern financial tools often favor the wealthy. Access to lower interest, higher rewards, and early investment opportunities create compounding advantages. Those without access pay proportionally more for identical services, silently widening wealth gaps. Consider how debt magnifies these effects. Payday loans, overdrafts, and high-interest credit accumulate rapidly. A small balance carried monthly becomes exponentially expensive, not through a single large transaction, but through repeated system charges. Mathematically, a 20% annual interest rate on a $500 loan grows to $1,200 over 5 years if only minimum payments are made. This is a real predictable cost, not an abstract risk. Over a decade, these patterns intensify. Individuals constrained by financial friction cannot benefit from compounding interest on investments, further solidifying the systemic advantage of those already financially stable. Behavioral psychology shows humans underestimate delayed costs. The pain of paying now feels real, but the invisible accumulation of small penalties is ignored, creating a disconnect between perception and reality. Economic cycles exacerbate this effect. Recessions, inflation, and credit tightening disproportionately impact those without buffer capital, turning ordinary missteps into significantly higher long-term costs. Systemic money mechanics are often invisible. Credit scoring, penalty structures, and bank incentives are not random. They favor repeatable, predictable financial behaviors typical of the already wealthy, making being broke comparatively expensive. Here's an everyday example. Buying groceries with credit to avoid a trip may seem harmless. Over a year, repeated minor interest charges can exceed the cost of planning or using cash, silently adding hundreds in unseen expenses. Short-term comfort frequently outweighs long-term thinking. Humans prefer immediate relief over future gain, and financial systems exploit this tendency. Over decades, this behavioral bias compounds cost far beyond visible spending. Visualize the difference between two people. One pays small fees repeatedly, the other avoids them through planning and timing. Over 20 years, these microcosts accumulate into tens of thousands, illustrating hidden financial drag. The psychological toll of being under-resourced reinforces patterns. Scarcity narrows attention, encourages reactive decisions, and perpetuates a cycle where even small financial missteps are amplified by the system. Hidden costs extend beyond money. Time spent navigating fees, managing debt, or correcting mistakes could otherwise be invested in education, side income, or personal growth. Opportunity cost multiplies invisible expense. Historical parallels are striking. Poor populations have consistently faced compounding disadvantages through systemic structures. Higher relative prices, limited access to credit, and punitive fees, confirming that these mechanisms are long-standing and persistent. Over 5 to 10 years, patterns solidify. The person experiencing small penalties and friction repeatedly misses wealth-building opportunities, while systemic advantages for the financially stable compound effortlessly, creating an expanding gap. Mathematical insight reveals exponential effects. Even minor differences in fees or interest, when applied consistently over decades, lead to outcomes that appear enormous relative to the initial misstep. Perspective shifts when we consider long-term consequences. Being broke is expensive not only in daily life, but in the opportunity cost of what could have been invested, saved, or leveraged, quietly amplifying inequality. By understanding these hidden costs, viewers can begin to recognize invisible leaks in their financial lives. Awareness is the first step. Systems are structured this way, but human behavior can mitigate cumulative disadvantage. Consider the power of compounding advantage. Someone with small reserves avoids extra fees, invests modestly, and builds credit. Over time, these seemingly minor differences generate far more wealth than extraordinary effort or luck alone. Short-term pain avoidance is often rational emotionally, but irrational financially. Paying slightly more now for convenience feels better, yet over decades it silently magnifies costs and reduces options for growth. Systemic design exploits predictability. Those constrained financially make repeatable choices under pressure, triggering fees and penalties, while those with access enjoy streamlined benefits that remain invisible until compared over time. Imagine two identical incomes. One navigates friction carefully, the other succumbs to hidden costs. 10 years later, the difference isn't merely visible in savings, it shapes freedom, opportunity, and resilience. Behavioral economics highlights loss aversion. People overreact to immediate costs but undervalue deferred expenses. This explains why small repeated penalties feel insignificant while their long-term impact is profound. Debt is a particularly strong amplifier. High-interest short-term borrowing, common among those under financial pressure, creates snowball effects where repayment consumes resources that could otherwise grow, reinforcing a cycle of scarcity. Over 20 years, compounded differences between careful management and reactive behavior can represent multiples of annual income. This is not luck. It is the predictable outcome of system design and human psychology combined. Hidden costs are often invisible until compared side by side. Two households with similar spending may experience dramatically different net outcomes due to subtle systemic advantages and minor recurring expenses. Time is a critical factor. Delayed investments and lost compounding opportunities are rarely considered, yet they often exceed the cumulative cost of visible spending mistakes, quietly creating long-term disparity. Consider convenience traps, prepackaged meals, high-fee services, or fast solutions. Individually minor, collectively they drain capital and reduce flexibility, while the alternative, planning and patience, requires effort but preserves wealth. Financial psychology reveals habits are costly. Small repeated behaviors, from late payments to impulse purchases, create patterns that the system amplifies. Over decades, these patterns explain much of the hidden expense of poverty. Historical inflation magnifies these costs. Those with fewer buffers pay proportionally more in real terms when prices rise, illustrating how macroeconomic forces interact with personal finance to silently penalize the under-resourced. Here's what most people don't see. Systemic inequity is embedded in daily financial mechanics. Not through malice, but through design that rewards scale, predictability, and buffer capital, resources the broke often lack. Contrast is clear when examining wealth thresholds. Crossing even modest thresholds reduces fees, improves credit, and unlocks cheaper financial instruments. Missing these thresholds maintains hidden penalties that accumulate silently. Opportunity cost remains critical. Money mismanaged or trapped in minor fees cannot compound. Over decades, modest sums invested consistently outperform erratic spending by factors often unseen in daily life. Behavioral tendencies reinforce this. Scarcity narrows focus, encourages reactive spending, and reduces planning. Emotional comfort dominates over rational calculation, quietly amplifying long-term expense in ways that appear invisible. Even with steady income, repeated minor inefficiencies, late fees, higher interest, service charges accumulate. These small repeated costs represent a predictable, calculable barrier to wealth creation. Systemic insight clarifies why cycles persist. Poverty is expensive not solely because of lack of income, but because small repeated disadvantages compound exponentially over time, shaping generational financial outcomes. Mathematical framing makes it tangible. A $50 recurring monthly penalty, left unchecked, costs $600 per year, $6,000 per decade, and $12,000 over 20 years, before accounting for lost investment potential. Psychological framing reveals human bias. Immediate relief outweighs deferred cost, and under pressure, predictable decisions favor comfort, convenience, and avoidance, even when they silently erode financial stability. Consider financial education gaps. Those exposed to systemic insights early can mitigate costs, avoid traps, and optimize opportunities, while others incur hidden expenses unknowingly, reinforcing long-term disparity. Invisible expenses affect decisions beyond money. Time, energy, and stress spent navigating financial friction reduce capacity for productivity, growth, and strategic thinking, subtly amplifying the cost of being broke. Historical comparisons show this is not new. Economies from early industrial societies to modern markets have disproportionately burdened those with fewer resources, systematically embedding compounding disadvantage into daily financial interactions. Over a lifetime, small penalties compound into massive differences. Two individuals earning identical income can diverge dramatically based on hidden costs, access, and behavior, illustrating the real price of being broke. Perspective shift. Being broke is expensive not only for what is spent, but for what is lost. The cost is both visible and invisible, immediate and deferred, monetary and opportunity-based, shaping long-term trajectory silently. Awareness is the first tool. Recognizing these hidden costs allows strategic mitigation. Choosing small effort today to avoid larger predictable costs tomorrow, demonstrating control within the constraints of systemic design. Behavioral shifts amplify impact. Deliberate planning, consistent avoidance of minor penalties, and leveraging small advantages compound exponentially, slowly converting predictable disadvantage into resilience over time. System design is constant. Financial structures will always favor predictability, access, and buffer capital. Understanding these rules allows individuals to minimize hidden costs even without increasing income dramatically. Over decades, cumulative small changes, avoiding late fees, optimizing credit, investing modest sums, produce results that far exceed immediate financial behavior. The difference is not dramatic effort, but sustained consistency. In conclusion, being broke is expensive because it exposes individuals to hidden costs, systemic friction, and opportunity loss. Awareness, understanding, and deliberate action turn insight into mitigation, helping long-term outcomes quietly but profoundly shift.